welcome back. Well, the market is holding on steady. At least 16,800 is being maintained, and market will be a bit tentative ahead of that big event. We'll get to know what the RBI Monetary Policy Committee meeting has decided in the next 15 minutes itself. But just to get a preview in terms of what should we expect, we are now joined by Mr. Sajjid Chinoy, the India Chief Economist at JP Morgan. Sajjid, hi, good morning. Thank you so much for making time and speaking with us. I'm guessing 50 basis point is the consensus, but apart from that, what are the other things that you would want to hear from RBI governor this time around?
Morning, good to be here. We do expect a 50 basis point hike. I think markets will be looking closely at what the guidance is. And there are two parts to that. Has the stance changed? I would expect the RBI would still say that they're withdrawing accommodation. Remember, the neutral rates by the RBI are forecasted to be in positive real terms. We may not be there just yet. Even if rates go up 50 basis points, the repo rate will be close to 5.9, and we still expect inflation, at least for the next 6 months or so, to remain above 6%. So it'll be a bit premature to expect that the RBI is done after this. I think we should brace ourselves, given a very hostile global backdrop, that more monetary normalization will be needed. And so I think markets will look closely at what the stance is. And secondly, what the forecast is. I mean, the good news at the margin over the last few months was the momentum of headline inflation seemed to be coming off. The momentum of core inflation seemed to be coming off. Global commodity prices have corrected, though they're still very elevated. But what's been worrying in the last few weeks has been the fact that the uneven spread of the monsoon is creating fresh food price risks. And we could see that manifest as early as the September CPI print.
Yeah, absolutely. And on the other hand, Sajjid, I also want you to, throw some light upon what's going on at a global level, because, India in that sense is not decoupled from the world at all. The dollar index strengthening also because of the bond yield rise and the kind of commentary that we've seen, not just from central banks, but now from federal governments themselves. We just heard from Liz Truss yesterday.
Absolutely. I think we need to understand the global context in which all of this is happening. India is not going to be insulated by this, a very unprecedented global shock. Think of what's happening. The genesis of the stronger dollar that you alluded to is the fact that the Fed is expected now to raise rates close to 5%, by 2023. These will be the highest levels of Fed rates since 2006, 2007, right? It's because of those rate hikes that capital is being sucked out of all emerging markets and advanced economies, and therefore both advanced economies and emerging market currencies are coming under significant pressure. The euro was at its lowest level since 2001, 2002. The British pound is at its lowest level in 5 decades. The Chinese yuan was at its lowest level since 2006. So everybody is at the receiving end. Nobody can be spared, and we need to understand the rupee movements in that context. And I think what will worry emerging markets, and especially commodity importers, is that you're hit by a trifecta. One is the strongest dollar since 2002. The second is monetary tightening around the world. This is the most synchronized monetary tightening we're seeing in decades. And the third is, despite their correction, commodity prices are still uncomfortably elevated. Oil, crude prices are still close to 90. So this is going to mean that emerging markets like India will need to buckle down and focus on macroeconomic stability. That will mean that monetary policy will have to be normalized, fiscal deficits will have to be brought down, and the current account deficit will have to be narrowed. So it's against that global and domestic backdrop that today's monetary policy action needs to be viewed.
At least overnight, we saw that the deficit number was lower than expectation, and even the borrowing figure for the second half of the year is not that aggressive. But Sajjid, what's your own expectation as far as the growth forecast and inflation forecast go? Because at least the growth forecast has been maintained over the last couple of policies at 7.2. Do you expect any sort of trimming there? And with respect to inflation, 6.7%, do you see it rising further?
So I think the key is going to focus on what the second half inflation forecast is. Remember, the RBI's forecast for the second half of this fiscal year from October to March on average was 6.1%. It remains to be seen whether they change that. For what it's worth, we believe there are upside risks to that because of what's happening with domestic food prices, especially cereals prices. So one will have to look closely to see when does inflation in the RBI's forecast dip below 6%, because the first kind of operative target of monetary policy here is going to be to bring inflation back into the tolerance band, back below 6%. And let's see when the RBI expects that to happen. On the growth front, I think we need to be realistic now that given the slowing global economy, we sometimes forget that last year when India grew at about 8.6%, exports contributed 3 percentage points to that. With the global economy slowing so much this year and Europe heading into recession, we need to be realistic that exports will not be providing those kinds of tailwinds. That, coupled with the fact that very accommodative monetary policy, is being normalized, is going to extract some short-term cost on growth in the coming quarters, which we need to be realistic about. We need to think about this as the short-term growth sacrifice to preserve and protect macroeconomic stability. But if you do that, then that lays the foundation for much stronger medium-term growth. Because in the medium term, there is no trade-off between growth and macro stability. All that said, if India can grow at close to 7% or just a little bit below, that will still be very creditable. I won't be surprised that if the RBI were to modestly mark down its growth forecast for this year.